But we have to hit the question that, like, how long have I known you? 6 or 7 years? And I've never asked this question. Why did your parents misspell Brien? Did they do that intentionally, or what's the deal with that?
Well, Jim, I'm the last of 8 kids in an Irish Catholic family. Do you need me to go on any longer?
No, I'm the 5th of 7. They just forgot. Right?
I've got more. They were running out of names by the time they got to me, so that favorite uncle, whose last name was O'Brien, they just lopped the O off of it and got creative.
Okay, I like that.
I also have 3 sisters named Mary.
So what do they go by?
Just middle names and nicknames, but all named after the Virgin Mary. So you can't get much more Irish Catholic than that.
I have one sister. Guess what her name is?
That kind of a thing. It's like Mary Ann, things like that.
Yeah, my sister's Mary Fran. Welcome back to the Futures Edge podcast. I'm Jim Uriel. As always, bye-bye to you on the Brains Behind the Operation, executive producer and co-host. And this is the Futures Edge podcast, which many are calling the greatest podcast in the history of podcasts. That's mostly my sister. We have Brien Lundin, who's the editor of the Gold Newsletter and the CEO of the New Orleans Investment Conference. So we have to hit, okay, I always, in my mind, correct me if I'm wrong, I think of you as a metals guy. Metals, of course, in my mind, means the Fed, it means rates, it means all that. So my first question, I think, to go right after this here, because I personally believe that the fact that the dollar's rallied, I believe it's 11 weeks in a row, interest rates have gone screaming higher over the last couple months. I personally think the metals complex, particularly gold and silver and copper, and we'll get to that in a second, have held in pretty well. Am I just talking my book because I'm long out the ass about those things?
Well, I'm the last person to ask that, because that's the biggest problem I have, is I always try to interpret things bullishly for the metals. I mean, my newsletter is called Gold Newsletter, so it's hard for me to look outside that. But yeah, I don't think you are, frankly, because, I mean, in August, just taking August as a snapshot, the Treasury yield was up maybe 15% from around the August time period. And the dollar was up. The dollar index was up about 5%. Gold lost 1% in August. Now, September's been, still sideways action. Today, as we talk, it's down a bit. But everything's down today. You say, you think about the Fed and you think about the metals. It's not so much the Fed affecting the metals or affecting gold. It's the Fed affecting everything, every damn thing. My big thesis is that we're in the end game of a trend that began when Volcker started cutting rates after he killed off inflation. And that's a multi-decadal trend where the Fed has increasingly played the hand in the markets and driven the markets. Every time there was any kind of a slowdown in the economy or recession, the Fed did one thing: it cut rates. Then when it tried to normalize it, it never got past the midpoint of the previous range. So if you look at the bottoms, it's just a steady stair step downward until 2008, and it hit the foundation, and then they had to come up with quantitative easing and everything else. And then came COVID, and they had to do so much more. So my big thesis is the Fed and central bank policy is driving everything, all the markets. They are overcorrecting at every turn, planting the seeds for the next crisis. And because of this long period, the markets and the economy, like Pavlov's dog, are now just attuned and addicted to not easy money, but ever easier money. So every time they have to come in to rescue, to get the same kind of reaction from this addicted patient, these addicted markets, they have to have more of the drug, and they have to do more than they did the last time. So that's basically where we are. I think we're in this end game, and I think you have to look toward Fed policy and the certainty of what they're going to do next at some point to guide your decisions, not just for gold, which I think is important in this environment, but really every asset class, everything you own, essentially.
So I'm going to answer it this way, and then I'm going to bounce a question at the end of my answer. And you guys feel free to jump in if you think I'm nuts or if I've said anything to you that's shocking in any way. I was never a you have to own gold person. And I changed my mind after the pandemic. And the reason is, to me, gold is the single most secure thing because I'm securing it. I'm sitting in my house. I've got gold here. I've got gold elsewhere. I've got guns here. I've got dogs here.
That's a warning to you fuckers who might think about coming, because I got gold here too. I'm waiting for you to come. Okay, go on.
I'm married to a woman who has a hammer throw record at her university and also shoots like Annie Oakley. So you're not getting...
Good luck. Good luck to you people.
Yeah. After I saw what happened in the pandemic, and this is not, I'm not taking a political stance here, and I'm not talking about policy at all. I saw a situation, you could take the Canadian trucker situation, whatever it was, where governments were able to force people into doing things they did not want to do. Pick one. Doesn't even matter to me what it is. And one of those things was they could force you to use a form of money you don't want to use, CBDC, right? They could take it from you at any point. And I said, I need something for as long as I breathe to make me feel comfortable about that. It doesn't have to be every part of your net worth, I think. But I never thought that pre-pandemic. I never thought you have to have physical gold. It was a tradable thing to me, right? Jimmy and I'd be on the trading floor and, I'd yell to him, hey, I just bought a couple contracts gold futures. It was just a thing. Mm-hmm. And that changed. And if you look at the performance of gold, when I looked to I started comparing everything to pre-pandemic because that old pandemic dip and the dip and rally was in basically everything, right? If you count treasury yields. I looked at it and I said, okay, I'm going to go back to end of 17, beginning of 18 and say that's pre-pandemic to me. Because otherwise you're taking the peak as opposed to kind of a middle level area. And in that time, copper's up about 12%. Okay, that's fine. That's great. The copper thesis, I believe, is a longer play. The S&P's up 59 and gold's up 49. But in that same period of time, these are rough numbers. Okay, in that same period of time, the S&P has had a hell of a lot more shit happen to it than gold did, to where it was all over the place. The Fed was affecting it, everything. And gold just it didn't steadily climb. It had rallies and it had drops. But it essentially, from the way people look at performance, performed almost as good as the S&P. But I would argue when you calculate the risk-adjusted performance, it was better, a lot better. Am I nuts?
Brien?
No, you're absolutely correct. And I could go on for about 60, 90 minutes on that. I mean, risk-adjusted return, if you look at modern portfolio theory and that, maximize your risk-adjusted return, there's always been a place for gold, 5 to 10% of your assets to try and reach that efficient frontier. These days, it's probably higher, but all of that stuff, all of those calculations are all back-tested. And I would argue that since 2008, the 60-40 portfolios are out the window. All the asset classes, the correlations, instead of being inverse to each other like stocks and bonds it's supposed to be, all the correlations are trending toward one. The CEO of central bank liquidity is floating all boats, or when the tide goes out, it brings them all down together. So that creates risk and danger. So if you try to create a portfolio according to the historic standards, you really can't and get that risk-adjusted return. But back to gold, you are absolutely correct. Over the long term, it stabilizes, it ensures, a portfolio ensures wealth against these sorts of things. It has throughout human history. I tell people who are new to the sector that there are two reasons to buy gold. One is for insurance, where you're doing what you're saying basically, and you're putting it aside, probably physical or some representation, and you're insuring against something that is going to happen, that in 3, 5, 10 years, the dollar's purchasing power is going to be significantly less than it is today. It's going to be a good bit less. You just don't know how much or what those, how quickly it's going to do it over certain time frames. So, you buy home insurance, but do you really think your house is going to catch on fire? No, but you still have home insurance. You know the dollar is going to be worth a whole lot less, and you know that gold protects against that over long sweeps of history. So that's why you own gold for insurance. Now, when you look at the macro picture and you say, well, this is setting up to where I think we are getting in one of those periods where people are going to really get worried about what's going on with the purchasing power of the dollar, where they're really going to be concerned about the credibility of the dollar or currencies in general. That's when gold really responds and overreacts. It's not an inflation hedge. It's kind of a freak out hedge. When people start to really freak out, that's when it makes up for lost time and then probably overshoots equilibrium. And if you see that you're getting into a period where that appears to be what's going to happen, which I think is right about now, then you want to look at the investment case for gold, and you want to try and leverage that trend by, buying ETFs, physical gold ETFs on margin, or leveraged gold stocks like, the 2X gold stock ETF, futures and options, trading mechanisms, mining stocks. Look at all of those different ways to kind of leverage that trend. And I think there's a real opportunity right now to do that. So that you need to own gold for both of those reasons, I think, right now.
So let me pivot to my question then, if I could, because the question is this. Part of the reason that I was never a gold, they call them gold bugs. I don't know why they call them that. Part of the reason I was never someone that said you have to own gold was because I really believed that Fed activism, for lack of a better word, was temporary. It isn't anymore, right? Jim, Brien, I mean, the Fed's
we're 41 years in my opinion. So
yeah.
I think that's almost like a Jerome Powell definition of transitory / temporary. So I don't think it's temporary.
It is. And if you look back on it, it even goes back to the 60s and the guns and butter deficit spending really started. That's when Nixon had to sever the dollar's last link to gold in 1971. He really didn't have any choice at the time, frankly. But at that point, I say it's like when that happened in 71, when you no longer had gold attached to gold. And for people who don't know, in 1971, it was illegal for Americans to own gold, but foreign governments could take their dollars, turn it into the U.S. Treasury, and get gold back. And they looked at all this deficit spending we've been doing in the 60s and said, well, the dollar is not worth what they say it is. So the Bank of England, Charles de Gaulle in particular, started sending all the dollars back and draining Fort Knox. So Nixon had to put a stop to that. So he just said no more. It's no longer exchangeable for gold. That essentially, to quote my late friend P.J. O'Rourke, that was like giving a bottle of Jack Daniels and the keys to the car to a teenager. And they immediately drove the car into the ditch, which was basically the 1970s. And after that, thank God for Volcker. Volcker killed off inflation, did things that we can't do today, or that Powell can't do today, because he had the tools to do that. He could raise rates 4 or 5 times over 20%, because federal debt was only 35% of GDP. Now Powell can't do that. He doesn't have the same toolbox, but he's trying to do it, and that's the problem. That's the real conflict that we're facing right now, in kind of a crucial period as we speak.
So I have actually 2 questions. The first one could be a short answer. Was P.J. O'Rourke really a friend of yours?
P.J. O'Rourke was a friend of just about everyone he met. He spoke at our conference 5 or 6 times. I'd never talked to him outside of the conference, but we had some interesting experiences during the conference. One time we were at a lunch. My mentor, the guy who started everything for us, Jim Blanchard, was still alive. And we had a lunch up in his suite. And we had G. Gordon Liddy talking about the Waco incident, which had just happened. And Liddy's to my right explaining how they should have sent in the kill teams, which was a whole nother thing. And he was so intense. I was looking at him, and he had his brain veins that were pulsating in his bald head. And I thought he was going to have an aneurysm and spray me with blood. And to this day, I remember looking across the table was PJ, and his eyes were like saucers. His jaw was on the table. He could not believe the things that were coming out of Liddy's mouth. But PJ was absolutely the the most gentlemanly and nicest person you would ever see. He came to speak at the conference. He came to every event, mingled with all the attendees, and felt like that was his job to do so. He was just
Wow.
a wonderful guy.
That's awesome. Now, here's the second question is that at your first answer, you talked about how Fed activism has caused this, you didn't say it this way, but correlation to 0 to 1 or whatever. Like everything has just traded on low rates and addiction to low rates. Were you encouraged, because I'm mildly encouraged, but nothing to move the needle that much, that the Fed was able to raise rates over the last 18 months, and still, I think something is going to break and fall apart. But are you encouraged at all that we've gone this far without anything breaking and falling apart?
Yeah, encouraged, amazed. I've been talking about this about 4 years, how the debt load that we've had is too high to ever have rates for any positive real rates for any sustained period of time. And Powell, I think, is the best Fed president we've had since Volcker. I mean, I've got a lot of respect for the guy because he has been bound and determined, and he's been trying to normalize things. But again, we are at basically $1 trillion in interest expense on the federal debt. Now, 20% of that debt is owned by the government, the GSEs, and so those interest payments go back to the federal fisc, but that debt still has to be paid because it's held by Social Security and everything else. So all the debt has to be paid back. 80% of it is downright bottom line interest expense. And so we're paying more now in interest on the federal debt than national defense. And all of that debt's resetting as we go. So it's going, if you look at the charts, headed straight for the sky. It's going to be updated in a few weeks, and we're going to be well over $1 trillion. And that itself may be a political, a political spark, I think, for the conversation, national conversation.
So for both of you, Jim, you as well, Powell has essentially implied that that's not his job. I mean, he's done it more than once since that first aggressive Jackson Hole speech. And because people have been bringing up what Brien just brought up over and over again, how this makes the debt completely untenable. Do you guys believe him? Or do you think
I'll start with that. He also says that he doesn't care about asset prices, yet we've never seen a real substantial equity market pullback. Today was the first day, we're recording this on Tuesday, by the way, that started to get really dicey in equity markets, and people started buying short on interest rate products, meaning that the belief is starting to come back that if the shit really hits the fan in the stock market, that will move the Fed's needle. That being said, what I'm saying is they say a lot of things until it starts to get really dicey. So I don't necessarily believe that he doesn't care about the federal debt. What
duration? Because I'm looking at the yields right here.
Didn't the whole SOFR curve get bought?
Yeah, that's what I'm looking at. The 4 month in really kind of rallied on the yield side on the 2 years still up, but so it was short.
Yeah, no, I was talking about the SOFR stuff that I was broken today, a bunch upside.
Go ahead.
Brien?
Yeah, I think that's what he's saying today. It wasn't what he was saying post-COVID. He actually did say it was the federal debt. If you remember, as they were coming in with all that liquidity post-COVID, he said, yeah, the federal debt is a problem. It is unsustainable, but that's not a problem for today. Right. We can't address that today. That's for the future. So by saying that, you're saying it's something that factors into your decision-making process. We had Alan Greenspan in 2016 speak at our conference. And Greenspan, in case if you didn't know, was an arch libertarian in the 1960s. He was about as radical as you could get. Amazing that he ended up where he ended up. And so he was asked by me, by our moderators, all kinds of ways, well, here you were, this ardent gold bug, this ardent libertarian, and here you go into the heart of darkness at the Federal Reserve. So antithetical to everything you espoused and believed and everything else. And why did you continue to finance the Treasury, the federal expenditures? And he basically, talking around it like he always does and did, he said it was his job to do it. He had to do it. And in fact, if he did not to do it, if he refused to do it, they'd have another guy in the job next week. who would do it. So what he tried to do, and it may have been a form of self-delusion, was while he was in the inside, try to, fix things or make things as good as possible. But in that job, that's your job. You have to finance federal spending.
So what is the deal? Like, it seemed to me the federal government, while inflation was running at 9%, let's call it really 14%, but they were misjudging it lower by several percentage points. It seemed like the perfect opportunity to cut spending and try to manage some level of austerity, because they could have done it under the guise of trying to fight inflation as well. And they chose the other path. Like, is this level of incompetence? Is it stupidity? Is it nefarious? Brian, what do you think?
It's the system. If you look at where the federal debt is now, there's a few ways to address it. You can raise taxes, but in all these cases, it's too far gone now for any of these to address it. But you raise taxes, you cut spending, you grow your way out of it. But to grow your way out of it, you have to cut taxes. You can't raise taxes. So you have to really cut spending, and they're never going to do it. The political system we have today, they cannot cut spending. Entitlements are already locked in for the majority of the spending anyway. So there's nothing you can really do except chip away at the edges, and they don't even seem to have the inclination to chip away at the edges. So that it really is a situation where you can't address where the debt is today, and you have to depreciate the currency at a greater rate than the interest you're paying on the debt, or everything just tumbles.
And this is what's interesting is when you talk about is the system, the structure of it is set up in such a way that, we talk about getting what we vote for. We vote for these people, so we deserve what we get. When there's no other option, and it's been my dream to get sort of a ticket of the ghost of Jack Welch and a Ken Langone as president and vice president, or as emperor and dictator, just for a couple years to fix all this stuff. But the amount of pain that the economy would have to go through, like what level of Vivek Ramaswamy, for example, is fond of saying that there are certain agencies he could close and other ones he could reduce headcount by 70% and they would still operate, right? And I think the public has no concept of that being possible. But then the pain on the consumer level is part of the reason that I feel like you have to buy gold. But if gold does what I think it's going to do, I don't want copper anymore. Does that make sense to you guys?
I think there are two different reasons why you want to own gold and copper. I believe we're in a generational opportunity for both metals, but for entirely different reasons. For copper, you have the whole electrification of transportation and everything else, and the fact that it takes so much copper to go into an electric car. But then to get the power to the electric car, you have to completely do the electrical grid. There's no substitution for copper in any of those, and I could go into a lot of detail, but there are massive supply constraints because there's been about 15 years of very little expenditure on exploration or development. So there's no way to react for supplies to really react to the rising demand for copper and in other battery and energy metals. So there's a real fundamental story there. For gold and silver, there's a monetary issue there. There's the end of this great trend that I was talking about of ever easier money and how that plays out. I don't think anybody knows how it's going to play out, or at least in any kind of detail. Nobody's that smart. But one thing we can probably be confident of, you probably want to own gold and silver going into it, or their proxies.
So that actually brings me to sort of the thesis that I'm struggling with right here, because as you said, the electrification, right?
Yeah.
So I was thinking about the UAW strike today, right? And if the UAW strike were to get worse or were to go on for a long period of time, that affects the ability of at least the big three here to stay within their EV timeline, which hits a little bit of the copper demand, right? At least a little bit of it.
Yeah.
And if you get a change in regime, the kind of regime that could restrict the Fed, it probably takes those EV mandates away at the same time, right? Because you have to somehow cut subsidies and you have to somehow decrease the cost of energy, which would then mean more carbon and less EV. And you have to stop depreciating the dollar, which in theory harms gold. So when you two guys talk about the relationship of inflation to gold, I understand that to mean the actual definition of inflation, which is the expansion of the monetary base, as opposed to CPI, which is what everyone else thinks it is, right? We all learned in university back when they actually taught school that inflation was the expansion of the monetary policy as opposed to an increase in the price level. Expansion led to increased prices, but it wasn't the same thing. So how do I square this circle where, to me, I already talked about it, and you made me feel better about it, that it is an insurance vehicle as well. But how do I square this circle with, if we could actually get the monetary problems under control, then the gold that I want to own isn't worth as much? Where am I wrong?
My view on that is you're not going to be able to get the monetary issues under control. People ask me,
thank you,
what should Powell do? And my advice to Powell would be to close his briefcase, walk out of his door, don't say a word to his secretary, catch a plane to some remote mountain cabin, and just hide, just run. There's no way out. There's no way out for him, for him or for the monetary system. It's a hell of a job to be in. I don't think that it is really fixable at this point. I think what's happening is at every crisis, the prescription creates the next crisis. The solution creates the next one. They overcompensate. They flood in liquidity. Pretty soon, whether it's the next blow up or the one after that, or maybe the one after that, the general public is going to say, well, we're getting these big blow-ups, and every time, all of a sudden, we get showered with free money. And more free money each time it happens. The next time it happens, that dollar of mine isn't going to be worth that much. So I got to spend it like mad. I got to do this. But bottom line is that currency is going to lose credibility, and it's not just the dollar. I'm not one of these people that think the dollar's going to crash and the world's going to rise over the ashes of the dollar. It's every currency out there. They're doing the same thing. They're in the same situation. So it's a loss of credibility in fiat currencies that I think is the ever increasing trend. Eventually, the only way to reestablish that credibility is to put an anchor, a governor on it against human nature, tie it to something, which would be, well, what could we come up with? What would be something?
Bitcoin.
Yeah, that may be a viable option, but I think it would be gold. I really do, because
Well, of course you do. I was just playing devil's advocate, right?
Yeah. But and maybe there's a role for Bitcoin or something like it in that environment. But I think the thing that really anchors it is what's been proven over time is gold, because gold is a proxy for work. That's exactly what it is. And it is a representation of value. And it's easy to do. There's no reason why you can't do it, because if you want to devalue, you can still mess with the currency all you want. So let's say it's, you set price of gold at $10,000 an ounce, and all of a sudden you say, well, we need more dollars in the economy. Well, today the price is $15,000 an ounce. So you can still devalue your currency, but every time you do it, it's out in the public. It's not gradual through inflation. It's not something you can blame on the guy behind you or the guy after you. It is totally, you have to do it out in the public. It's just a method of accountability.
Okay, I have a question. Well, first of all, I want to interject something real quick. There was a speech I heard from Warren Buffett, of all people, who I think he usually says brilliant things. And he was talking about the total amount of gold on the planet mined and unmined would fill up like 3 Olympic-sized swimming pools or something like that. So there's clearly not enough to back the currency. And I remember thinking, well, that's dumb. I'll just triple the price of it. Okay, now there's enough. You know what I mean? So it just seems silly. But anyway, that wasn't the question. The question was going to be is that, so in the meantime, it doesn't seem like you can earn an effective rate of return on gold. Is there ways to earn interest? And when it's sitting juxtaposed against a 5.5% 6 month, does that make it less attractive? I know that it does, but how do you resolve that?
Yeah, it's not a growth asset in that regard. You can't compound it. There are ways you can do it, but to do it, and somebody may come up with a system or a scheme that will prove me wrong, but I steer clear of the earned interest on your gold schemes and the like, because you have to lose control of your gold in some way or manner to do it. You can, use futures and options to basically have the gold taken away from you at a strike price, and then in the meantime, you're earning interest, but you can still just re-enter the trade after that. So you can do things like that. There are different reasons to own gold. If you're going to own gold as wealth insurance, then you want to put it away and know that your earning power, your interest, is directly related to the decrease in the purchasing power of the currency. And, you mentioned what Buffett said about, there's not enough gold and you can just triple the price. Gold is probably, I think it is, the only element on the face of the planet where you could triple its price tomorrow and not upset any industry at all. Because in every use that it's in, except jewelry, and jewelers are just going to raise the price or cut the carat value of their jewelry. But in every other industry, the amount of gold used in manufacturing is so small that it has, no effect or very little effect on the end price. So you could triple the price tomorrow.
I bet demand would increase in that instance as well. I actually think it would affect jewelers to the upside.
They locked in the prices. I mean, they don't really care, because if the price triples, they're locked in at the old price for their costs.
So let me ask you guys, from a perspective of here's why I don't agree with anyone who says the proper asset for this is Bitcoin. And again, full disclosure, I have owned Bitcoin. I actually made quite a bit of money on a percentage basis on the Bitcoin that I did own. And again, full disclosure, I don't own any right now. My whole thesis for wanting to own gold at this stage is based on, I want a percentage of my wealth, however small, to be where nobody can take it from me.
Yeah.
And I don't care what they say. Like you just mentioned, the government outlawed owning gold at one point in our history. How in the hell does anyone think that they wouldn't do that to Bitcoin in order to not lose control of the everyday monetary function? I mean, I say this to people like, well, they can't, because we'll still trade it amongst each other. If you can't pay your taxes with it, it has no value.
Yeah, I think they won't seize gold again. Who knows? They did it before, so they could do it again. But I think that they won't really be able to do that. The overriding factor that you need to keep in mind is that government always seeks more power. So not only will they take your Bitcoin, but they're going to beat you over the head with it. They're going to take the idea and they're going to create their own central bank digital currency, and they're going to take that power. They're not just going to eliminate your power, they're going to take that power, or they're going to try to do it. That's the most dangerous thing I see on the horizon. That's absolutely the four horsemen of the apocalypse are represented by those three letters in CBDC.
So we talk about central bank digital currency on this show quite a bit, because I put that as my number one threat to the freedoms that we enjoy in this country. And like, people are like, what are they going to do? Well, I'll tell you, I mean, what the Canadian government did, if you gave money to the Canadian trucker strike, they froze up your accounts. And like, well, eventually they let people have their money back. No. If they freeze up my account for 5 minutes, in 50 years, I still remember that they froze up my account for 5 minutes. It has nothing to do with allowing you to have access to your money again. They've already tipped their hand. I think this is an enormous thing. So the candidates that have come out against it are who so far? Can we list them? I know Vivek has and Ron DeSantis has. Have any other ones on the Republican side come out against it, or any side?
I can't name them.
I don't know if it's really that big of an issue in the general public's consciousness. And I think that's something that we all need to try and take on our shoulders, try and make it as big of an issue. That's the only thing that can stop it, is to make that, another third rail of politics, that you just don't go there. You're right.
I'm trying, man. It's hard.
If they took it away from you and gave it back, all they're doing is establishing the precedent that your money is their money, and you get to use it by their good graces, and that's it. So I'm no big fan of our political situation in the U.S., but I have a lot of friends in Canada, and it's unbelievable.
Wow.
What's
going on there is crazy.
It's unbelievable how the public, and then everybody I talk to in Canada says it's just crazy and scary. And then you look at the polls, and it's not reflected in the polls.
Yeah, this is insane.
Brien, how do you look at the gold-silver ratio? And do you look at it, and can you juxtapose that with the copper to gold ratio?
Yeah, the gold silver ratio I don't think has much use in terms of timing or trading. I think it gives you an idea of relative valuations in every sustained bull market in gold. It's always been based on monetary issues. People should never buy gold because of any kind of a geopolitical dust up anywhere in the world. It's no reason. You're just going to end up holding the bag. Somebody's going to buy before you and they're going to sell before you. But if in a long-term bull market, gold bull market, silver has always outperformed gold significantly. So it's kind of an unexpiring option on gold, natural leverage. And I think that, if you're owning both when silver is dramatically cheaper than gold relative to historic averages for the gold silver ratio, then you might want to lean more towards silver. But that's about it. I don't think it has any kind of a timing value. Gold, copper, I think in today's environment, there are reasons to buy both that are really powerful, but completely different. So I don't think it has value at all, really, at this point.
Okay. A couple minutes ago, we were talking about the $1 trillion in debt service that the federal government's going to have to pay. And we painted a pretty grim picture, which I think is an accurate picture, too. Are we saying hyperinflation, or what is it exactly that we're saying when we look at end game of poor policies if we don't get rescued from this, Brien?
I don't talk about hyperinflation that much because, number one, it kind of labels you as a kook in these days, so you lose whatever little credibility you had in begin the conversation. It's hard to imagine the U.S. getting in a hyperinflation kind of environment. Maybe we didn't even get there in the 1970s, but it doesn't really matter. If you have sustained inflation over 5 to 6%, it changes everything, and the depreciation of the dollar accelerates, and it changes people's habits and everything else. I think before we got to hyperinflation, you may have a bout of something that could fit that definition. That may be that point I talked about where people lose credibility in the currencies. But it's not just going to be the dollar. Everything's connected these days. If it happens in the U.S., it's going to happen in Europe. It's going to happen in UK. It's going to happen in Japan. Everywhere.
Okay, so then to swing it to Bobby, so what Brien just laid out, and I think this is what's emboldening us to do the stupid things that we've had, that we've done, and the poor stewardship of the currency, because they still realize it's the world's tallest midget. And when you look at the euro and you look at the yen, and they're doing the same bullshit. That's one of the reasons we're doing what we're doing, because the belief is that in the end, global money is going to come to the dollar as the last resort, regardless of what we do. Is that what you think too, Bob?
To a certain degree. I mean, part of what worries me, so I tend to look at the correlation with yields more so than with the dollar. And by correlation, I mean inverse correlation. Yeah. So for example, Brien, you can correct me if this is not the same thing over a longer period of time historically, but Jim and I are much more active. So I'm looking at 180-day correlations, and the treasury yield has an inverse correlation somewhere in the 90 range, and the dollar is more in the 62 range.
To gold?
To gold. Yeah. And I think it has to do with what you said about people panicking and buying gold, because at the same time they buy the dollar, right? They bought dollar-based assets when there's these panics. So you can see gold and the dollar rise at the same time. But when you're seeing that, you're seeing yields fall. So it seems the falling yields to me is the short-term gold prop, right? Yeah. But yeah, the first time I ever heard race to the bottom for currencies was in the Eurodollar pit, the interest rate floor in the 90s. And I was like, what the hell do they mean by that? We want a strong currency, right? But it doesn't seem to be that way anymore.
Yeah, you're exactly right. It's kind of an unpopular opinion in the metals world. People watch the dollar index as an indicator or a driver for gold. In my opinion, it is not. It's correlated with gold, but the driver is treasury yields. The driver is Fed policy. Treasury yields move the dollar and gold inversely, but they are the driver. That's the engine for both those after effects.
So I think the invention of the dollar index and the fact that people look at it and call it the dollar does a grave injustice to valuing what the dollar is. To put that in perspective, and this is, I know you guys know this, but people are watching, the dollar index is comprised of over 70% of the euro and the yen. And the reason when it was started up, there was no euro and all those currencies combined. So the euro in the end, guess what the Japanese are doing? They're the most profligate spenders, the most yield curve control, create currency, devalue the shit out of the currency. And we're seeing that too. And the euro is the same thing. So just the existence of the dollar index causes this psychological mistake to be made, thinking the dollar's strong. Measure that dollar against a bag of groceries and see where you get that value of the dollar. Where am I wrong?
You're not. I like to quote that great financial analyst, Albert Einstein.
Jim Uriel? Albert Einstein?
Yeah, and that everything's relative. And and that's it for the dollar index. It's just the dollar against, like you say, the euro and the yen primarily, but the most important trade currencies. The dollar, the U.S. economy, it's say the cleanest shirt in the dirty linen basket. You can say it's the best looking leper in the colony.
That's a new one. You just made that up right now, right?
No, I did not.
Okay, we have to take that to committee to see if it's approved.
Made that up years ago. Here's your credit anonymously. I can't remember where I got it. That is absolutely stolen. I can't get it out of my mind, and you can't get it out of your mind now.
Now, right?
The dollar index is a nothing. It really is, and I'm a big believer now in Brent Johnson's dollar milkshake theory. I think it makes a lot of sense. That initially the dollar is a safe haven. Every now and then you see gold go up with the dollar index because in certain scenarios they're both perceived as safe havens. And you can have treasury yields, well, typically they plummet because that's a safe haven too. You can have these supposedly contracyclical moves because they are both safe havens. Over the long term, though, gold is the one thing that protects against all these defects in not just the dollar, but all currencies. And gold is in a raging bull market in every other currency but the dollar.
So the last serious thing I have to ask you, by the way, I always use the tightest T-shirt in my closet, which basically means T-shirt.
Same as all the others, right?
We pull it off.
There's the rest of them. When I look at gold going forward, I need to throw a disclaimer in this because I don't want people to go out and buy gold. You need to do your own research, all that other bullshit that they make us say. I can't find a scenario where it's not worth more 10 years from now. And that has to do with part of it being the safety part of it. If the dollar blows up completely, everybody's going to want gold. If the dollar strengthens, it's probably on the fact that the economy is strengthening and the Fed's going to hike rates to cool inflation, and the gold's going to stabilize, but it's not going to collapse because everyone is going to be expecting the Fed to flip, drop interest rates, or succeed against inflation, which is going to drop interest rates again, in which case gold then takes advantage of that inverse relationship. And people tell me all the time, well, inflation's coming down, gold's an inflation hedge. No, gold is preemptively an inflation hedge. When the Fed is trying to cause inflation is when gold rallies. Yeah. People think gold's an inflation. It rallies prior to inflation, not when the Fed is fighting inflation, and yet it hasn't fallen. So my question is, tell me where gold doesn't work. What's the scenario?
Well, in today's scenario, I don't see a path forward where it doesn't. But I want to congratulate you on that point, Bob, because very few people get that. They talk about how gold did not react to the surge in inflation that we saw last year or earlier this year, and therefore it's not an inflation hedge. Gold took off right after COVID,
right?
When they saw what the Fed was going to do, and then what the repercussions were going to be. The only scenario where gold will not do well right now is if the Fed has rates at 5% and keeps them there and kills off inflation, gets it down to 2%, and there aren't any significant lagging effects and repercussions, such as 20% of the U.S. companies that were zombie companies and unable to pay their debts in a zeroed interest environment can suddenly now pay their interest, the debt service costs, when their debt service costs are multiplied fivefold. So
accounting humor is the best kind of humor.
Yeah, maybe something happens, all of a sudden they can pay those debts. Maybe there's not a run on bank deposits because you can get 5% in treasuries and you can get 0% in your bank deposits. Maybe that doesn't reignite.
I have a question for both of you now, Brian, because we're kind of running up against time here too. The Fed, we're still pricing about a 30% chance they hike again. I think that's bullshit. I think they're done hiking. But the real question is the futures market is pricing in eases starting somewhere after the middle of next year. I personally think that that's fair. I think that there is a delayed punch to feeling the efficacy of these rate hikes, and part of that is due to the fact that prior to the first rate hike, 10-year yields were under 2% on average for 5 straight years, allowing anyone to roll into duration who wanted to. And so everybody's sitting back and going, oh, sucks to be you having to borrow at these levels. I don't have to. I think when we start to get the 1-2 punch, the Fed's going to ease second half of next year, and I think they're going to do it aggressively. Do you agree with that?
Yeah, I think so. And I don't know what's going to be the precipitating factor, but I think...
Well, we never do, right?
Yeah, that's the thing. I think it's going to be something we're really not either haven't thought of or haven't thought of much. And I think that's probably going to be a surprise out of left field to some extent. But we know what's going to happen. You don't go from the easiest monetary policy in human history to one of the harshest tightening cycles ever seen with the flip of a figurative switch and not break a few.
Not suffer.
Yeah,
right.
Something's going to happen.
By the way, Bobby told me exactly what's going to happen, and I stole it as if it was mine on the radio this morning, which, by the way, I don't feel any guilt about. But you said commercial real estate is where the real cracks are and the real fissures or fissions. What is the thing? Fissures. It was where as soon as the weight is put on that could be the thing that cracks. Where do you think about that, Brian?
Yeah, I think that's one of the candidates. I think the banking crisis reigniting, because that was the business practices of Silicon Valley Bank and First Republic and the like, they weren't that outside the norm of what most of them were doing. So that couldn't start in a flash. I think there's a tsunami of debt resets. Jim Grant says $8 trillion in incremental additional debt service payments once debt resets to current levels over the months straight ahead. That's going to hit the global economy. There are a number of things that could start it, but we know that that's what happens. What the Fed overreacts today is going to cause the next.
As long as you mentioned Jim Grant, by the way, we haven't plugged enough the New Orleans Investment Conference, which a lot of people for years have been saying they want a conference where Jim Grant and Jim Uriel speak together, and finally they have it.
Well,
haven't they all been saying that?
I noticed you mentioned this the other day too, and I appreciate it, but Jim Grant is unable to make it this year for scheduling.
Oh, shit.
Yeah, thank you for that. But I've got everybody else.
What? We have Brent Johnson. Let's go with Brent. Brent Johnson, the dollar milkshake. Was it my imagination, or was Jim Grant at some? He was going to be there, wasn't he?
Yeah, he was last year, and he said he was going to be coming, but he had a conflict.
Oh, shit.
Yeah,
sorry about that.
I got 2 things to say about the conference. Number one, we got Brent Johnson coming up on the podcast in a couple of weeks. So nice. We'll definitely plug the conference again, and you don't have everybody.
But you don't have Bobby Iacchino.
I want to show you guys something. Brian, you mentioned debt service for these companies.
Yeah.
And I was sent a chart today, and this is another one of those situations, Jimmy, where I don't know if I'm allowed to share it, but I'm going to do it anyway. So at some point, we might get a cease and desist. And if we do,
not before the show's out, though.
Everybody can find us probably still on Rumble. I'm not sure. Corporate sector's external financing needs. So it's free cash flow. FCM's free cash flow.
Okay.
All right. So share of companies with negative free cash flow is higher than it has ever been. If you look, this goes back to January. So
negative free cash flow. Okay, good. Yeah.
This goes back to January of 95. So it's not ever, but it probably is ever.
And
there's not so much corporate financing going on prior to the 90s, right?
Most corporate debt has not reset near current levels.
Right. And this is corporate sector external financing needs. This is the percentage of companies with negative free cash flow. So when it reset, but that's to Brian's point about debt resetting and what these corporations, these zombie companies are going to be able to do with it. And the answer is nothing.
All right. Is there any positive thing that anyone can say before I hang up, before I shoot myself?
Yeah. The most positive thing I can see, the brightest light on the horizon, is the fact that you're going to be in New Orleans in a few weeks.
Yeah, we're going to have so much fun.
Everything. Tell people how they can get tickets and stuff.
Go to neworleansconference.com. neworleansconference.com, and there's probably a special link you guys have too that you could put in the show notes or anything. But I've got you on a panel with Dave Collum and Lynn Alden.
That's fantastic.
And
nice.
On the booms, bubbles, and busts panel. And Peter
Fantastic.
Bookbar is going to be in that panel as well.
Oh, good. I love Peter. I have a feeling you put Dave and I together all the time because you think we're both bordering on lunacy.
Yeah.
And you like to see where the circus goes. Am I reading that right?
Peter's all calm and steady. You guys are like flailing it.
Yeah, absolutely. I'm trying to bring what happens behind the stage when we're all talking with Dave in the green room onto the stage.
That's really weird.
With some limitations, because Dave has dropped a couple of euphemisms that I won't repeat here.
You can repeat them. Just don't.
Repeat me here. Right?
Dave's
one of the
guest, and we're looking to get him on again soon because it's just so fun.
That's why my wife comes to the conference, Brien, is because she's just enthralled with listening to Dave talk. So last year we sat at that bar at the hotel. And by the way, if you guys are all there on Thursday night after my speech, I can rope Dave into coming too if he's not with you, Brien. And we sit at that bar and talk to people, and we have a gas. Yeah. And I'm looking forward to it again if you guys come.
Yeah, you watch Dave like people watch the Indianapolis 500. You know, they're waiting for the wreck. He's so funny. You never know what's going to come out of his mouth.
And I love when he talks about getting suspended from Cornell and then hiring lawyers and fuck you people. I'll say what I want. He just stands up for it. He's got a bullshit meter that smells this much. Yeah. Bullshit.
Yeah. Thank God for tenure.
Thank God. Yeah, exactly. So thank you, Brien, very much. This was a ton of fun. I'd love to do it again sometime, and I'll see you in New Orleans. We'll have a ton of fun as always.
It's going to be a blast. Thank you so much.